Hi everyone, I am Sarathamani, Assistant Professor, Department of Commerce. Today we discussed about tax planning. Okay, for tax planning is nothing but an analysis of financial situation or plan to ensure that all the elements work together to allow you pay the lowest tax possibilities. Okay, there is an consideration, that is tax planning is deduction planning bills. These three are taken key principles of the tax planning. Okay, there are 5 heads of tax planning. First one is income from salary, income from house property, profit from business, capital gains, other sources of income. Okay, first one is income from salary. When a person receives a paycheck for his job from a company, it is called as salary. There must be contract existing as per the rule of law, which can establish that the payer is the employer and the receiver is the employee. Once this is estimatable, and an employee can receive the salary in the following terms, that is fees, wages, advances, allowances, pensions, gratuity and retirement benefits, etc. The second heading is income from house property. The income earned by the owner of the house property is taxable, but only the house property is let out on rent. When then the income in the hands of the owner become taxable. In case of the house property is self-occupied, there will be no income. Okay, the formula for tax liability on the income from house property is calculated such as earnings minus expenses equal to profit. Okay, the next heading is profit from business. The profit made by the business is liable for taxation. However, one should not confuse with profit and income as the term. Income from business means the allowable expenses incurred while running the business. Is profit. In order to compute profit from business, it is the important for the taxpayer of the allowed expenses available under deductions. The fourth one is capital gain. Capital gain tax is based on holding period of the capital assets. There are 2 categories of capital gains, the long term gain and short term gain. Okay, short term capital gain is any asset or property which sold within less than 3 years of acquisition or considered as short term considered as the short term asset. Hence the property earned by a single selling the assets is called to be short term capital gain. In shares, equities, if you sell the units before of the purchase date, the profit should be considered as a short term capital gain. Long term capital gain, the profits earned by selling the property or asset after 3 years is called long term gain. Okay, in the case of equities, LTCG is applicable if the unit have been held for the least 1 year. Capital assets that are classified as long-term capital asset if the period of holding exceeds 12 months includes, that is units of UTI under zero coupon and bonds, equity share that are listed on any stock exchange, the units of the equity oriented mutual funds. The last heading is other sources of income. There are other types of income sources which will fall under other income, that is interest earnings, dividend earnings, gifts, provident funds, income from games like lottery, races and race course, etc. Okay, the calculation of the income tax liabilities list down all the sources of income, categories of this income below the 5 heads. Okay, thank you for watching. If any queries, kindly send me the comment.